Recently, there have been some bold headlines in the media regarding Toronto real estate. Here's one example from the Financial Post. What it was like to get caught in Toronto's swift and brutal housing plunge. From the Toronto Star, GTA home sales down 40% in March compared to last year. And from the Globe and Mail, luxury home sales plummet in Toronto. You can find links to these articles in the comment section. Most of these articles are focused around two numbers: sales volume and average sale price. As of April 2018, sales volume from across the GTA is down 32% from the previous year, and prices are down 12.5%. But let's take a second look and go back to April 21st, 2017. That was the day the non-resident sales tax took effect in Toronto and around the Golden Horseshoe. That's a crucial date for understanding the current market conditions, because leading up to April 21st, 2017, there was literally buyers from around the entire world rushing to buy Toronto real estate before the non-resident sales tax took effect. So what happens when you get a massive surge of investor money creating a bottleneck in the real estate market? The result is twofold. Both sales volume and average prices quickly begin to rise. In hindsight, does it really come as a surprise 1 year later that sales activity and prices are down when we consider what was happening in April of last year? So where are we now? As it stands today, the market actually bears some resemblance to what we saw in the height of the financial crisis in late 2008. At the time, the average price in Toronto was also down 12%, and sales activity was down 45%. But the scary thing about the Toronto real estate market in late 2008 was that inventory had reached an all-time high. What does that mean? Well, it means there was a record number of homes sitting on the market and not selling. The Toronto Real Estate Board has an index number for measuring housing inventory. It's known as MOI. It stands for months of inventory. In December 2008, the MOI reached a record high number of 7.6. That means that as of December 2008, based on the market conditions at the time, it would have taken just over 7.5 months to sell off all the properties that were currently listed for sale. I think everyone understands the concept of supply and demand well enough to know that if the supply is high and the demand is low, prices begin to fall. We also now know MOI is a measurement for understanding how quickly housing inventory can be sold off. This past April 2018, the MOI index for Toronto was at 1.6. That means it should take just slightly over a month and a half to sell off every single property currently listed for sale in Toronto. That's not a long period of time. It's actually nearing historically low rates in Toronto housing, and once you begin to understand this number, you can easily argue that the 2008 Toronto real estate market was in much worse condition than today's current market. Now, despite some of the numbers from the spring bearing a resemblance to 2008, it's important to understand these two corrections took place for very different reasons. However, these corrections are connected. In order to make the connection, we need to consider what the long-term impact of the 2008 American subprime mortgage and financial crisis had on Canadian real estate. Because of the volatility of the American housing market, Canada, and specifically Toronto and Vancouver, began to see an increase of international real estate investors looking for a safe place to park some of their wealth. So you see, by January 2009, the market in Toronto began to shift, and the Toronto real estate market was on its way to a speedy recovery with a substantial run in property values that lasted for 9 years before finally being extinguished by, you guessed it, the non-resident sales tax of April 21st, 2017. The good news is, if we fast forward to today and compare the sales data we have from 2009, when the recovery began, compared to the start of 2018, we will see a very striking resemblance. Obviously, it's still too early in the year to say with certainty that in 2018 we will see the Toronto market make a full recovery. However, I believe the effect of the non-resident sales tax is now wearing off, and we are in the early stages of recovery here in Toronto. This time around, we don't have the same level of international investment to help with the recovery, but that's okay, because pressure previously created by international investment prior to the non-resident sales tax was not going to be sustainable. Today, we still have steady population growth. Despite stress testing, interest rates are still very manageable. The Canadian banks are in good standing, and the mid to entry-level condo market in Toronto is already very hot. Based on the numbers we're seeing regarding MOI, it's clear to me that property owners and investors are prepared to hold their ground and wait for prices to return. I predict that in the near future, we will enter a stable growth period whereby annual appreciation will likely begin to rise with or slightly above inflation rates, creating new market conditions that are much more sustainable and healthy.